Hello, everyone. Today we're going to talk about how to raise Series A plus venture funding during turbulent times. Today, my guests are Yusuf and Manuel. Thank you so much for being here. We're very excited to pick your brains and understand your views of fundraising landscape in the coming years. So why don't we kick off with a simple question of, can you tell us a little bit about your firms and the types of companies you invest in? And then we can start from there. Why don't we start from Yusuf?
Thank you, Nur, and thanks for having us on this webinar. Very excited to be here. So I'm with QED Investors. QED Investors is a global fintech fund. We invest in North America, LATAM, Europe, which I head up our activities here, Africa and India and Southeast Asia. We've been around since 2009. We've been quite active, have done many deals and a lot of unicorns across the globe in LATAM. Nubank, for example, we're one of the first investors in there. Credit Karma in the US, Klarna here in Europe, and many other investments across Africa and Asia as well. We typically invest in Series A, but with our latest structure, we can go all the way from a PowerPoint stage up to a growth check, even pre-IPO in some cases. So we can go through the entire life cycle of investing. And I think what makes us unique is we are made up of ex-operators. We tend to spend more time with each company we invest in, and we're solely focused on fintech. So we're very much fintech specialists. That's all we've been doing at QED, and many of us before we joined QED. So that's what sets us apart. And we really enjoy working with entrepreneurs such as yourself.
Thank you so much, Yusuf. Manuel?
Yeah, great to be here. Manuel Silva, I run Moro Capital. So somewhat similar to what Yusuf was saying. So we're also fintech specialists. We are a 7-year-old fund investing at the crossover basically of financial services and technology. And similarly, quite international, with 40% of our portfolio in the US, 40% in Europe, EMEA, and then some investments also in Latin America. We also invest at the early stage of the value chain. We work with entrepreneurs to accelerate their ideas or their company. Anywhere from seed stage to Series B, I would say that's probably our typical entry point. And again, being specialists, we think we understand financial services better, the complexities of regulated industries, the complexities of selling to banks or selling to the fintech sector, and so we try to bring that expertise as well to our 40 plus companies in our current portfolio.
Thank you very much, both. It really sounds like you are both perfectly suited for this panel. And then just to give you context about this panel, I would basically be in the shoes of entrepreneur who is looking to raise funding in the next year or so, Series A plus, and then there are lots of questions that my fellow entrepreneurs would love to understand, and then pick the brains from VCs directly and understand how you see that, and then what exactly you would want to see in the entrepreneurs. So the questions are going to be tough, and then again, if anything you don't know how to answer, let me know. But otherwise, I hope we can get to a position where we can speak transparently and talk about the industry and different things. But thank you so much for being here. So the first question, in the last few years, we saw many companies receive fat checks and big valuations. How do you think this will change as we head into lean years with tighter budgets?
Yep. Thanks, Noor. We definitely see a change in the industry. And we started seeing this at the beginning of this calendar year. It started in the public markets, as we know, and a lot of public fintechs lost a lot of their value, and a lot of them actually delivering good results, having good earnings calls, and the stock prices nonetheless going down. So it was really driven by the public markets, and we saw that getting translated into the private markets where we operate as Series A, Series B type investors. And so the change is there, and I think everybody listening to this webinar would probably be feeling that as we speak, so I will not go into the details. So yeah, I think that we will see a big change. But what's unique about the industry is that the change may actually in some ways be good, both for the companies and both for and for the funds. And I don't want to sound overly optimistic here, because it certainly will be tougher than people were used to, but there's a silver lining. And there's a few things. One of those is that some of what we would call the tourists in the industry may leave. So what we've seen over the last few years is what a lot of people that didn't fully understand fintech were coming in and investing in companies. And they were investing without fully understanding the complexities of regulation, the complexities of fintech, what it takes, what the risks are, what the liabilities are of a regulated business, what it takes to run a regulated business. And as such, in some cases, we saw some investors give not so great advice. And we saw some companies, in some cases, taking actions that relied on money always being infinitely available. So I think both of those things changing isn't necessarily a bad thing. I think it puts the industry on a more sustainable basis. And we see that as a positive. Now, it doesn't mean that there's not going to be pain. Having to do a down valuation is not easy. And perhaps we'll talk about it a little here, how you can navigate such a tricky situation if you're a founder. But in all this pain that we're going to experience, and we are experiencing, I think there is a silver lining, and that is that we can put everything we're doing on a more sustainable basis.
Thank you, Yusuf, and I agree with that. Manuel, do you want to?
Yeah, no, I agree as well. I
anything?
mean, you have seen me nodding because everything that Yusuf said is very much true. I mean, I think ultimately what we're seeing is that we're back to fundamentals, right? And I think the past, let's say, 2 years, there was maybe, let's call it an excess of money, or there was a lower bar for selection of which companies should be funded and should make it to the next stage of development, so to say. And ultimately, we're going back to fundamentals. And what does that mean? That means that it takes time to build companies. It takes time to build companies in regulated industries like fintech. And it's a journey that a lot of times spans across 8, 10, 12 years sometimes, right? And I felt that the market had lost a little bit that time horizon of what it really takes to build kind of generation defining companies. And we were in a little bit of a zero to IPO mode in 2 years, which was let's say wrong, or was at least very much decoupled to what it really takes, right? And ultimately, as Yusuf was saying, a lot of the way companies were making decisions, a lot of how they were thinking about run rate, the way they were thinking about product development, hiring, et cetera, was based on the very fast-paced promise, or fast-paced premise more so, that ultimately may not be all that true, right? So we're definitely going through times of readjustment, and ultimately the CEOs and the companies that have good economics, understand what they're doing, understand why what they're doing makes sense for the market, why customers are happy, companies that are optimizing for operations, optimizing for budget, really understand marketing and how much money needs to be spent to acquire revenue, et cetera. Those fundamental business decisions. So whoever understands that and is building towards that will thrive in this ecosystem, and whoever doesn't really cannot do thinking about it, or doesn't have the ability to now think about it from the vantage point, will go through tough times.
Yeah. And I would like to just add one thing, Noor, which is, I know we're going to be getting audience questions here today. So, and one question we get a lot is about down valuations and what happens. And I mentioned that earlier. And I think one thing that's very important to think about, and we talk about a lot with our founders, is a down valuation isn't necessarily the end of the world. So if you're running a public company, maybe your stock is down 60, 80%, and they can't hide from that fact. They have to deal with that fact. When you run a private company, there's a pretty strong temptation that, well, I can actually kind of hide from it. The market's traded down, but my next round could be an up round. And maybe it could be, and that's great. So strive for that. But I think there comes a point for a founder where you may be looking at a fork in the road, where the choices are between taking a lot of risk and really pushing and just making sure that you deliver something so exceptional that you can do an up round. Or the other path is, delivering really good results, doing what's right for the business, but that may result possibly in a flat down or maybe slightly up round. So one thing we usually say is you should not run your business only to do continuous up rounds. You should run your business to do what's right for your business. And then valuations may go up and down, but the important thing is always to do what's right for your business. And we actually see some people losing sight of that and almost treating a down round like a death sentence. It doesn't have to be if it's managed right. What is more important is doing what's right for your business and being realistic about market situations change. Sometimes it's really hot. Sometimes investors pull back. Pricing for revenue multiples can go up and down. But your job as a founder is to build an amazing business. We say the same thing for IPOs. An IPO is not a business goal. It's just a way to finance your business. Your strategy can never be to have an IPO. Your strategy should be, how do you build the best business you possibly can?
Makes sense, and then that definitely resonates with a lot of startup founders. I think thinking about different things of getting to unicorn, getting to IPO, those milestones can seem to be, I think, something that you chase, but actually the actual business is more important. But I totally agree with you. And then thanks for mentioning that. Maybe Manuel, do you have anything to add in terms of down rounds?
No, I mean, I think that's true. I think what the current situation is really forcing people to do is to be more creative, right? And if you look at the kind of term sheets and rounds that were set up, they were very simple. There was no structure. There was a price, an amount, etc., etc. And somehow we forgot that a round is a little bit of a meeting of the minds, where different people, an entrepreneur with its company at that stage and people with money are getting together to build the future together, right? And I think if you think about it from that perspective, it opens a much wider blank canvas, I would say, of how to do things, right? And maybe down round is one thing. We're seeing structures coming back. We're seeing legal terms to adjust valuations after the fact. We're seeing different kind of conditions precedent coming in. So ultimately, people are being just more creative on how to continue building their business. And I would say on a positive note to the audience, every single GP, every single fund is looking to make sure that the best possible businesses in their portfolio are supported through these turbulent times, right? And so instead of manufacturing a path and valuation that may or may not make sense at that point in time, right, where you should take advantages of those investors that you have that really want to support you and figure out a way in which you can catalyze that support to your company and together with them make the most possible business within that portfolio, right? And ultimately that requires creativity and humility and sometimes resetting certain things for a brighter future in a way.
Makes total sense. While we talk about fundamentals, the fundamentals of raising funding aren't changing. Companies still need to prove that they have a concrete team solving a concrete problem. What are the 2-3 most important KPIs that companies should focus on right now in order to fundraise? What do you think?
Yeah, that's a great question, Noor. So one thing we're a bit known for at QD is our focus on unit economics. And I think that's as true now as it's ever been. So I think focusing on your unit economics is going to sound maybe obvious, maybe cliche, but actually beyond just an intellectual understanding and paying lip service to it, really just focusing on that is, I think, one of the top things that founders can do at this point in time. And we see the market, and we've seen it now for more than a decade. And some founders instinctively do this more, and some rely more on just growth for growth's sake. I think the current environment is going to favor unit economics more. So if you were one of those that were more on the growth side, growth at any cost, etc., it's probably now a good time to start thinking about how am I getting that growth, right? Is it sustainable, etc. Number two is in any round, as you do a round, be very clear on what is it you want to learn from this round. Given where you are in your funding cycle, you may not get to profitability at the end of this round, but you can be very clear on what it is that you want to learn. And that could be something as fundamental as product market fit. It could be something around testing a expansion of the market, etc. But you're getting money from your investors to learn something, and you got to make sure that with the capital and the resources and the people you have available, you get the maximum amount of learnings to better build your business going forward. So those would be two key things I would point to, and I'm sure Manuel has several others as well.
Yeah, I think just build that. I mean, as you can see, ultimately, the two things that Yusuf was saying, it's all about looking under the hood of the business, right, and working together to make those businesses successful. So, another recommendation I would have is, work with your investors, both new and old, right? Work with them, engage early, engage in those conversations, advertise your business, get advice, et cetera, and engage them in that kind of more business decision making through the journey, which is something that was a little bit lost over the past few months, right? Where ultimately people would show up, send a term sheet, close around, but not really look at what's under the business. And ultimately, if a company, any startup is, again, a little bit of a meeting of the minds of investors and operators, that conversation is as fluid, as long lasting, and as as much a precursor of the moment when you need to raise money as you can. Again, both with existing investors, but also as you approach new with investors, to make sure that everybody's on board and everybody understands the status of your company at the moment of fundraise, but also what you're trying to build, and what you're trying to achieve, and what success look like, but also what the turbulences may affect and how they may affect your business, and how collectively you guys can all work together, right? So I think that conversation and that hybrid state of involving your investors early on and more deeply into your business is key for fundraising over the next few months and years, I think.
Thank you both. I think these questions obviously are quite important for fellow entrepreneurs as they get prepared for their next fundraising and an understanding what to focus on. I think it's a key when you fundraise. While we're on that, I think another question that I get quite often from fellow entrepreneurs, where we kind of gather and think a lot of how things might look like. Everyone is quite curious. The multipliers for companies who raised in 2020 to 2021 were crazy, up to 200x. What do you expect the multipliers to be in the next year, and what do you think can help increase the multiplier?
Yeah, I mean, I think focusing on multiples too much is probably a bit of a risk. And I've written a couple of Twitter threads and blogs on this, where ultimately for a mature business that's going to grow in line with GDP or a bit faster than GDP, let's say, you're going to be valued on a PE multiple, and typically those PE multiples, and this is like earnings after paying taxes, right, are going to be 12, 14 times, right? So any business as it matures trends towards that. Now in the Series A, obviously things are very different because you're growing so fast, and multiples could still be 200 times if the circumstances warranted. And coming up with a formula for what the multiple should be at a Series A stage is almost impossible, because if the businesses look set to grow 15x in the next year, then obviously it's going to have a very high multiple today, because people have already priced in that growth. So I would say, rather than focusing on just a revenue multiple, focus on the fundamentals of your business. Now, having said that, because valuations are down, as long as revenue for a given stage stays broadly the same, it just stands the mathematical reason that revenue multiples will come down. And I think the thing to keep in mind there for founders is, don't try to create what I call sometimes the Frankenstein's monster, which is you look at all the deals that have happened in your space and happened to other founders, you take the best characteristics of all and expect all those best things to be true for your business. It's never really going to work like that. And you may get a great investor, but you may have a slightly lower revenue multiple than your peers did. That's fine. Or you may get a good revenue multiple, but something else in the deal may not be exactly as you expected. So just focus on the merits of the deal as a whole. Try to get the right investors that are going to support your business in the best way possible. And if that means that revenue multiples are down even dramatically from where they were a year ago, that's fine. Realize that it's better to own something a little bit less of a great business than to have something that's going to have a lot of problems and not grow as fast. So I think that's the long answer. The short answer is revenue multiples may go down, and that's okay. You can still build great businesses and do very well as an entrepreneur in that environment.
Makes sense.
Yeah, no, fully agreed. I mean, ultimately, multiples are really, obviously they're going down, right? I mean, there's no doubt. But again, at the early stage, it's all about the quality of the business, right? And we operate in regulated industries, and we operate in industries that have long sales cycles when you look at the B2B, and that have unique differentiation elements that are not necessarily correlated to revenue today, but they may be in the future, right? So somehow, if you only take revenues on multiple as your only proxy to assess whether a deal is adequately priced or not, you're probably missing all those other building blocks that companies have had to build or are building that are going to be the pillars of success for the future for that specific business, right? And ultimately, you need to factor all of that into how you price it, right? I mean, again, at the early stage, the multiple conversation is interesting because obviously there's a waterfall effect through the sector from the late stage and from the public markets into the private. But ultimately, it's as if you were saying, or you were asking me, can you predict what the IPO market is going to be in a year's time? I could say, well, to be honest, any prediction would be a little bit pointless, because ultimately it's where your business is at that moment that would really count, right? So focus more on the fundamentals, focus more on what are the key differentiators and what's the moat that you're building, and that's really where the value is, and that the rest is kind of math only.
Thank you both. I mean, I totally agree what you mean by that, but I maybe digging a little bit further on this question still, because I guess any entrepreneur that I speak to, they're like, okay, if I go fundraise Series A, Series B plus, and so on, what's the benchmark should I look like? Because back then, when you fundraise A, B, C, you look at, okay, how much of a percentage I should give up for the ownership of how much I raise. Is it 20%? Is it 10%? Is it 15%? What's the benchmark? What's the benchmark in multipliers as well that you're currently seeing? Is there any average, or there is no such thing as average and everything is looked at as an individual? Is there anything you can help founders to think of? What is the benchmarks we can look at to understand if I'm even in line, or what I'm even thinking, if possible, it's not even possible, so I don't even need to bother of raising at this point?
Yeah, I would say talk to your investors, and because every situation is so unique, and if your existing investors, angel investors, other ones, and other investors that may not have invested in you, they can give you pretty good guidance on what the market looks like today. Because if you are fundraising as a founder, you will get a good understanding of the market for sure. But us as VC professionals, we are always in the market, so we can really help you get a sense of that. So get that realistic expectation, firstly, from investors. Second is, how much dilution you should expect depends on your business. I mean, if you're going to build a very capital-intensive business, let's say a lending business, that's going to require a lot of funding in various forms. You're going to get more diluted, and you should build that into your expectations from day one, and make sure you're happy with that and set the expectations for that. So it's a little bit like saying, be true to yourself, to what your business is, what it is. So those are some of the sort of advice we give. And there's cases where maybe dilution gets too much. And in that case, there's always conversations to be had with investors around top-ups, and saying, okay, listen, I'm so diluted now that maybe it's time to talk about an option top-up. What should that look like? I want to make sure I'm being motivated here. So there's always solutions to all these problems that may come up.
Yeah, just to pick up on a couple of things that Yusuf just said. So I think the use of funds, right? What are the milestones that you want to achieve with the money you're raising, are going to be particularly crucial over the next few months, right? And that's a topic that has been a little bit forgotten over the past few years. But ultimately, I think the correlation between the money you need and what you want to achieve with that is where I would start the conversation, right? Because somehow everything starts with that, right? And then in terms of dilution, it's really about incentives, right? At the end of the day, as an investor, you're backing a team who's committing to delivering on those milestones that you're funding, for the long term. And ultimately, if they're not aligned with that, if the cap table structure doesn't make sense, if the previous investors are not happy, and then you're going to be having some sort of governance issue, et cetera, you don't want that to happen, right? So ultimately, it's how you rearrange the pieces and what's the resulting valuation, but how you rearrange the pieces so that everybody's on the same boat and incented to make everything work and make things happen, right? So it's a little bit different than just a basic math. I think right now it's really, again, back to fundamentals, understanding what is the maximum accelerator you can have for your company, and up to the next round in a way.
Makes sense. Thank you both. the next question kind of already been answered, but I will ask you maybe some of the things you can add to that. But some companies who raised big rounds in the last couple of years have to raise smaller rounds with lower valuations. And then we talked about down rounds as already. But what do you, I know you give some of the advices, but what do you advise you have for how to talk to investors? What do you exactly to tell to your investors before thinking about the down round? How do you see that? Like, what are is there again any benchmarks on what is the minimum you should raise or maybe you shouldn't raise, or is it again depending on business, how you want to survive and so on?
Yeah, I mean, we talked about down rounds, so I won't repeat that. Hopefully, that was useful for the audience. One thing I will add is this is obviously, has a silver lining. Good things can come out of it, but it is obviously a very stressful situation to be in when markets are going down significantly, both for founders but also for investors, right? So this is not necessarily an easy period for anyone. We may not realize it, but actually, and I know some do, we are in a pretty stressful situation as the sort of fintech community in terms of what we're going through. And I think we're all feeling it in different ways. So given that that's the case, I think it becomes even more imperative to have very good relationships with your investors. And I've seen this possibly go wrong in a couple of instances, and it's never a good thing. And what needs to happen is you need to have a good relationship at a personal level, for sure. But a good relationship is more than just going out to dinners or having a drink or having a coffee with your investor. It is actually about how you communicate, being very upfront with bad news, being able to deliver difficult messages. So when something bad happens, it could be that you may have to do a downrun. It could be that your revenue decline. It could be that your costs are getting out of whack. You have to do a RIF urgently. Whatever the message is, delivering that openly, quickly, in a very transparent manner with your investors is more important now, I think, as the waters get more choppy than it's ever been. And a lot of founders, I've seen them sort of get stressed out in these situations. And some of them, not all obviously, will have a tendency not wanting to deliver bad news. That is never healthy and not good in any relationship. So as much as you may be having dinners and coffee with your investors, also how you communicate information and how open you are matters more now than it ever does, I think.
Yeah, nobody really more than your investors are incentivized. Well, CEOs are, of course, but to keep the business afloat and to keep things moving until the times are better, right? So ultimately, anything that builds trust around that mission, that joint mission that you have with your investors, is going to be helpful, right? And as you was saying, if you lose the communication, then your investors are not on top. If not on top, they would be prioritizing maybe other startups within their portfolios, because ultimately, they look at we look at things on a portfolio basis ultimately, right? And so ultimately, you also want to be doubling down on the companies where you see that you can make the most impact and where you feel that joint future is most bright, right? And if you're not really building the trust to be on that list, then ultimately your investors would potentially lose interest or worse, right?
Yeah, no, I totally agree. I think transparency is a key in any relationship, right? Is it with your investors or with your family or friends or anything like that? So I guess it is similar to many things. And then thank you for that. And then I mean, there's a lot to learn from the audience, from the questions we discussed today. Another question I have is that about going global. So, as Rima First, we help companies to hire people in 150 countries through EUR or contractor solution. But there are a lot of questions fellow founders ask as well when they think about going international. How important you think is for startups to broaden their revenue base? I guess in different ways, thinking of diversifying your kind of client base, looking at the different economical factors in some countries. If economy is going really down, maybe you need to diversify and think about different regions, different geographies. So do you think companies really thinking about that would help them prepare for the next fundraising?
Yep, I think so, for sure. Diversifying revenue, it can be good, and global expansion can be good. Now, especially for fintechs, crossing geographical borders is not always easy, and very few fintechs can do it easily. But that doesn't mean that you shouldn't do it. And if you do it, you want to focus on what you're good at, and hiring and the HR side of things should not be your concern. And it's great to have companies like Remote First that can help with that. And beyond diversifying revenue, diversifying revenue is not the only reason you may want to hire people internationally. As we all know, a lot of people have developers remotely as well. And in those cases also, you don't want to be too distracted with how do I hire in different countries across Europe, across the Americas, etc. And then being able to use someone like Remote First is a great asset to have for founders.
One thing we're seeing in these times, and it's all over the press and all the time, is some of the restructurings that a lot of companies are doing, right? Especially on the tech side, but also on the business development side. And ultimately, we see that as a massive opportunity to tap into talent that may be remote, right? And ultimately, if a CEO is trying to navigate, the P&L to make sure the company is performing as well as it can in these turbulent times, well, P&L, it's P&L, right? So you have the revenue, but then also on the cost basis, there may be ways to getting operational leverage or getting increased talents and talent density by precisely think a little bit more globally, right? And that's where you guys help a lot for sure by simplifying that and by really allowing some of those niches of talent that are remote and that are oftentimes untapped to be brought into a global talent flow, right? And I think that's key. The other thing where I think that's actually really interesting is, talking about all the people now in the tech industry that are looking for the next opportunity, that should also create a new set of, new entrepreneurs and new companies that I'm personally very excited about. And I think those are going to be game-changing companies in fintech and in many other sectors. And those guys would need to also think about their teams in a much more global way, right? If we've learned something about COVID, is that fully remote work is actually possible, and actually there's some benefits to it. And I think a lot of the new companies are going to be based and going to be built on that premise. And so enabling them to do that in a simple way like you guys do, that is for sure going to be an asset for them, and where we see a lot of the future of the industry going.
Thank you both. The final question from me would be, what is one final piece of advice you can give to startups looking to raise Series A plus funding in the next 12 months?
Well, there's a lot of advice we can give. But I think, the main thing is that you should be very clear on the goals you want to achieve in the round, right? So, I mean, we can give, 20 pieces of advice here. So I'm picking one, and that is know what you want to achieve in this round, right? And that goes back to the point on what do you want to learn? Okay. It also goes to the point of what kind of investors do you want? And to be able to answer that question, you need to know where do you want to be in a year and a half or 2 years when you need to go back to the market. So, realizing what you want to do is quite important. And to be able to do that, realizing what you do not want to do is probably equally, if not more important. So at a Series A stage, it's an exciting stage because the whole world is your oyster. You can do so much possibly. So knowing what you're going to focus on, knowing what you're not going to do is equally important. So being focused is another aspect of that same piece of advice.
Yeah, for me, the piece of advice would be communicate, right? Bring your prospective investors early on in the conversation, make them part of the design of what you're trying to do, right? Get early feedback from them. Even if you're not raising, or even if you're just thinking on how to structure the round, get that early feedback and make them, part of your journey very, very early on. Because ultimately, they will give you the best feedback, they will give you the best input, they would help you structure things, and ultimately they would help you, or you would help, or that process more so will help build the trust that you need for them to, close on the round and be part of your journey, right? So definitely communication, and early communication is going to be key.
Thank you so much, Yusuf and Emmanuel. I think this webinar was hopefully very helpful to a lot of founders who are fundraising. I believe we learned quite a bit of things, starting from down rounds, going to multipliers and then different KPIs that people can focus on. I think those are the things, even for me as a founder, is also important. So I try to speak from the shoes of the founders, and then hopefully we're able to achieve and help them out to thinking of how to navigate fundraising in the next 12 months or more. Now, I think we're going to go into questions from the audience. Let me have a look a few before we wrap up this call. Oh, here's the one good one. When trying to raise Series A plus, do you as investors about the team or the metrics, and why?
I can take that one. I mean, it's interesting because for me, the team is an input to the system, and the metrics to some extent are an output, right? So somehow I feel that you can't do anything without the right input, right? So the team is key, right? The team is key in many ways. The team is key in that you're entrusting them to deliver, but also, in turbulent times, you need a team who's able to be mentally flexible, to be well organized, et cetera, to basically counter all the obstacles in front, but also take them, grasp the opportunity and make the best out of it, right? So team is key, and I would, I mean, I think both are important, but if I only have to choose one, I would say the team is the basis of everything.
Yeah, no, I agree with that. Team is super important. I think I'll maybe give a slightly different twist to it. So in a sense, we look at both, but look at them in different ways. The way I think about a team is obviously fundamental, especially at the Series A stage. And to some extent, the team can develop, get better over time, as we all do as humans and professionals. But to some extent, you have some limits. Like people can only change so much, right? So we take the team to be very important, and we don't really assume there's going to be a fundamental change in how somebody acts or behaves or their values and so on, even though, as I said, people can always improve. Versus what the metrics can change a lot. Now, that doesn't mean we don't look at metrics, but we look at metrics with the lens of what do we learn from the metrics. So to use a very simple example, if you're looking at a lending business, maybe their unit economics today at the Series A is not so good because they're getting a 12% cost of funding. But we know that, at scale, they could reduce that to 6%. So then we would plug that 6 into the metric. So we almost ignore that element of the metric. But we would look at the metrics very carefully from a sort of response rate perspective. How responsive is the market to this product? That can then give us an idea of product market fit. So the metrics, we look at it with a different lens, knowing they may change, but it's this lens of like, what can we learn from the metrics? So why are we looking at the metrics in the first place is the question we ask ourselves.
Perfect. Another great question. How can my startup stand out when reaching out to VCs in the next year?
Yeah, good question. I mean, I think any good entrepreneur, any good CEO needs to be able to explain why what they do matters in a single sentence, right? And I think the startups that stand out are the ones that have done that kind of introspective exercise of explaining why what they do advances the industry they're in, and why what they do is different and better than what their competitors are doing, right? I think without that, it's hard to engage in a conversation that creates excitement. As investors, there's a bunch of opportunities we have in front of us, more than we can probably process. and ultimately, if you don't create that spark in the beginning of the conversation by really explaining what your value proposition is very clearly, very neatly, I think it's tougher. So I would definitely focus a lot in making sure that that's as crisp as you can.
Mm-hmm. Yep, and I totally agree with that. And I would add maybe, so one is going back to Manuel's point about communication. Communicate clearly, obviously, but also find the VCs that are more interested in what you're doing. So target those early and invest more resources into the ones that are a better match for you and what you want and for what they want. And the last thing I would say is be very humble and open in your communication. We find it very disarming, and it generates a lot of trust when we feel like founders are open with us. And if they share problems, their mistakes, what has not gone well, that is something that makes people really stand out, because a lot of founders instinctively think that they're putting on a show, they need to look perfect, they're in control of everything. well, we're all human beings. So founders who realize that and can be vulnerable really do stand out, actually.
Totally agree with that. And then the last question we'll take and wrap things up. My company is trying to raise next year. When do you think is the best time to raise in 2023?
That's a crystal ball question in a way. Well, I guess but it's a good question because it's a little bit of a wrap up of the conversation we just had, right? I mean, ultimately, the best time is when, well, of course, when you need it, right? But also the best time is when you're able to really communicate that milestones-driven view to prospective investors, and that you've managed to kind of create that excitement about your project, right? Without that, you can't really go fundraise, right? Now, if the question is how is the year going to evolve, that's really the crystal ball question in any way, in a way. And you would have opinions that the year is going to get better as the year goes, and there's going to be opinions whereby the year is just going to be as it is today, and nobody really knows. But ultimately, what you can control as an entrepreneur is the level of readiness of your business plan, the level of readiness of your vision, and the level of readiness of your team, and the willingness to execute, right? So focus on that, and the rest, it's not something you can control to some extent.
Yeah, no, that is indeed a very good question. I would say I've seen a lot of examples of trying to optimize this, and it's very difficult to do. So let's just wait till the market gets better. Well, you cannot predict the markets. Well, let me just wait because I'm going to deliver this great revenue in 2 months and then I'll do it. Well, that may not pan out exactly as you planned either. So trying to plan around those things is extremely difficult. So I think just try to keep it simple is what I would say. So one such rule of thumb is if you, at some point, if you have less than 6 months of runway, you don't want to be fundraising when that's the case. So if you're going to have 6 months of runway in June, then you should start fundraising in January, even though you may think that the market's going to be better in June, for example. Also, if you have very good momentum, that is one where it's probably a good time to bring it forward a little bit. And in this environment, plan for more time and more resources devoted to this. So normally, if you would have thought, I'll do it now, in 3 months, because then I'll dedicate this much time, etc. I realize when you say this much time, that's going to change now. It's going to take a bit longer. So maybe multiply your usual expectation of a fundraise by 2x. So if you think it's going to take 2 months, 3 months usually, maybe it's going to take 4 months, 5 months this time. If you do it sooner, faster, that's great. But sort of put that sensitivity into your expectations, if you will.
Mm-hmm.
No, I think that perfectly summarizes our call, and there's a lot to think through. But first, I wanted to thank both of you. It was a pleasure to pick your brains and then understand how you think of coming years, and then really appreciate your time. Thank you so much.
Thank you, Noor.
Take it over.